Hey there, welcome back to our channel. In today's video, we will be talking about Chapter 3 of The Intelligent Investor by Benjamin Graham. This chapter is titled A Century of Stock Market History, the Level of Stock Prices in Early 1972. In this chapter, Graham provides a detailed analysis of the performance of the stock market over the past century and offers his perspective on the market's current state in 1972.
Graham begins by noting that the stock market has been one of the most significant drivers of economic growth in the United States over the past century. He notes that despite several major market crashes, including the crash of 1929 and the market decline of the 1930s, as the stock market has generally trended upwards over the long term.
Graham provides detailed charts and tables that show the performance of the stock market over the past century, including the growth in stock prices, dividends, and earnings per share. He notes that while there have been periods of market volatility and decline, such as during the Great Depression, the overall trend has been one of steady growth.
Graham also notes that the stock market has become increasingly accessible to small investors over the past century. He notes that while in the early days of the market, only wealthy individuals and institutions had access to the stock market, today, individual investors can easily purchase stocks through brokers and mutual funds.
However, despite the growth and accessibility of the stock market, Graham notes that investors must be cautious when investing in stocks. He notes that the stock market is highly cyclical and that investors must be willing to accept the risks of investing in stocks, including the risk of market declines and volatility.
In particular, Graham notes that investors must be careful not to become too optimistic or too pessimistic about the market's prospects. He notes that during periods of market optimism, investors may become overly optimistic about the potential for high returns, leading to excessive speculation and inflated stock prices.
On the other hand, during periods of market pessimism, investors may become overly pessimistic, leading to undervalued stocks and opportunities for savvy investors to purchase stocks at a discount.
Graham also provides his perspective on the state of the stock market in early 1972. He notes that while the market had experienced significant growth over the previous decade, there were signs of potential market volatility and decline.
In particular, Graham notes that stock prices had become significantly overvalued, with price-to-earnings ratios well above historical norms. He notes that this could potentially lead to a market correction or decline.
Graham also notes that there were signs of potential economic instability, including rising inflation and high levels of government debt. He notes that these factors could also contribute to market volatility and decline.
Despite these potential risks, Graham notes that there were still opportunities for savvy investors to find high-quality stocks trading at a discount to their intrinsic value. He advises investors to remain cautious and to focus on building a diversified portfolio of stocks with strong fundamentals.
In conclusion, Chapter 3 of The Intelligent Investor provides a comprehensive overview of the performance of the stock market over the past century and offers valuable insights into the potential risks and opportunities facing investors in early 1972. Graham emphasizes the importance of caution and a long-term perspective when investing in stocks, and advises investors to focus on building a diversified portfolio of high-quality stocks that are trading at a discount to their intrinsic value.
So that's it for today's video. If you enjoyed it, don't forget to give it a thumbs up and share it with your friends. Also, make sure to subscribe to our channel for more videos like this. Thanks for watching and we will see you in the next one.